The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A Fed-friendly inflation print and a mic drop moment for the AI trade. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Here's where we stand. Just about an hour to go. You can see slight gains for the S&P 500, even with that mic drop moment from Oracle, helping out the benchmark a little bit higher by about 0.3%. This is interesting. The NASDAQ 100 pretty much unchanged on the day. And you might ask, how can that be with Oracle's rally? Oracle actually isn't in the NASDAQ 100. It's not listed on NASDAQ. Kind of fun there. Anyway, the Russell 2000 down a little bit here. Of course, it's not getting any of that Oracle momentum that we're seeing maybe in the S&P 500. And the Russell 2000 lower on the day, the small caps, even though you're seeing a pretty big rally in the bond market right now. 10-year Treasury yields lower by about 6 basis points. Once again, we are looking 4% in the face, Romaine.
Yeah, and we talk about Oracle, not in the NASDAQ, but it is in the S&P 500. One of the reasons why the S&P is on pace right now for its second record high in as many days. Oracle having its best day since 1992. The data software and cloud company saying its order book likely to swell to 4 times the size from a year earlier, while Chairman Larry Ellison, CEO Safra Catz outlining a scenario where its cloud infrastructure division alone expands 7-fold to $144 billion within 5 years.
Many that are skeptical of maybe like some of the growth. You look at these numbers, that ARR number, that's a drop to mic.
The results are the latest evidence that the AI infrastructure boom still has a long runway ahead. Wall Street forecasters rushing to boost their outlook for the S&P after those earnings, as well as the earnings of the season just passed. Big tech having a phenomenal showing. Deutsche Bank strategist Pinky Chada raising the year-end target to 7,000 over there, implying about a 7% jump from today. Barclays and Wells Fargo also boosting as well. But of course, the trajectory of markets, despite the AI spin, still dependent on the macro, the health of the economy. A PPI report today that did suggest inflation might be somewhat contained, but there were indications as well in that report that the containment may only be temporary. Wholesale importers appear for now to be eating the cost of those tariffs instead of passing those costs down the line to the consumer and, of course, down through the economy.
And I wanted to take a look at how these different concerns when it comes to the macro economy to, of course, what we're seeing in the AI trade, how it all filtered through at a sector level. And it's pretty interesting. If you take a look over the past month, this is really where it really felt like the baton was handed off from inflation concerns to labor market. Whereas you can see that up at the top still is communication services. A lot of that is coming from Netflix. Then you have healthcare and energy, 2 names, 2 sectors that have really struggled over the past few years. A very uneven trade there, but at least for the last month or so, they are working. And then you train your eyes down here to the bottom. Utilities, one of your biggest losers. And then consumer staples as a sector, that is down 2.4%. That is your biggest loser over the past month or so, which is interesting, Romaine, because if you're worried about the economy, if you're worried about inflation, you might expect consumer staples to perform here, to show up, but that just hasn't been the case.
A lot of questions here about the complexion of this economy. A lot of questions here about the complexion of the state of U.S. financial markets. Lori Calvasina joins us right now, the head of U.S. equity strategy at RBC Capital Markets. And Lori, that is where we start. I mean, you take a look at the earnings season, you've seen the economic data, and you've seen the record highs where the S&P seems perched right now. Where do we go from here?
So look, it's a great question. Excuse me, I'm having a little bit of allergies. If you look at where we've been in the market, we've been trading more or less in line with some of our more bullish scenarios in our targeting process, and specifically our sentiment models. I think what's really interesting is that we've seen the big cap tech trade really kind of regain its footing today. I mean, obviously with one stock, up an enormous amount. But I think what was really apparent to me in this last reporting season is that going through, all the tech commentary sounded pretty good. All the AI-related commentary sounded pretty good. And of course, if you look at some of those more tariff-exposed sectors, so things like industrials, materials, healthcare, we were seeing margin compression in terms of forecasts. So we really think that, you're sort of seeing the part of the market and the part of the kind of corporate sector that's been strong fundamentally rearing its head back today. That being said, Romaine, I think we are seeing that big cap growth part of the market bump up against valuation highs. So we think things are going to be pretty choppy from here.
Yeah, and we should point out, I mean, Katie, you were just showing that great board a little bit earlier, kind of talking about the complexion of some of the gains that we've seen in the various spaces here. And Lori, it gets to this idea as well. I mean, we kind of talk about the idea how the stock market, certainly not the S&P, is not necessarily a full reflection of the economy, and that there can be economic weakness, economic pain out there. That doesn't necessarily mean that the S&P itself has to also follow lower. And I am curious if you could kind of talk about that disconnect, maybe the idea that if we do have a strong NVIDIA and a strong Oracle and Microsoft, et cetera, is that frankly just going to be enough to keep this market going, even if some of the more economically sensitive sectors are going to be laggards?
So look, it could, Romaine. I mean, it depends on how much the mega cap growth stuff stays resilient, how much that goes up, and how much the rest of the market stays weak. So it's really, a bit of a sliding scale. What I will tell you, Romaine, is that I think I've talked to a lot of investors who have been geared up for broadening trades. They've wanted to rotate from these big mega cap growth areas over to small caps, over to value sensitive areas. What we know is those tariff sensitive areas are struggling a little bit in here to manage through the tariffs. Now, the S&P 500 at record highs kind of defies that narrative, but we are seeing that underneath the surface. And if you look at small caps, they're actually down on the day. And we've told people, if you look at sort of the rate cuts, people have wanted to get so bulled up on these more cyclical parts of the market. We've said, look, if you look at the cuts, those tend to be sort of short-lived boosts. And we do worry that the kind of lackluster fundamentals will ultimately catch up with you. So I think that's part of why, frankly, Romaine, even though this market is making new highs, it's creeping up to them very, very slowly. And it's not doing it on fantastic breadth. And so, it feels like underwhelming, achievement of new highs in here.
It does feel like that, doesn't this slow crawl to record highs, these incremental gains that are just pushing us higher and higher. But I'm glad that we're talking about small caps. It's one of my favorite areas to talk about. And I know the market isn't the economy, but if you're looking for a proxy, it feels like the small cap, the Russell 2000, is the place to go, because you think about yesterday, for example, we got those BLS downward revisions to the payrolls number through 2025. The S&P 500 hit a record high. The Russell 2000 fell by about 0.6%, Lori.
It did. And, it's interesting because if you look at the valuations in small cap back on April 8th, they hit a recessionary type low. I think they're around 12.75 times on that forward PE, and that's very much in line with recession type lows, very much in line with some of the lows that we've seen after, say, the 10% drawdown of 2023. But where you're sitting today, you're sitting at around 16 times. So you're comfortably above average. Recent peaks have been around 17 to 18 times. So, we even look at that part of the market and say, you really have to get incredibly excited from here. If you think that we've got some choppy fundamentals that are coming up, even that space is looking a little bit overvalued.
And Lori, I want to bring this conversation to the sector level as well. Of course, we were showing the sectors month to date over the past month or so. I see in your notes that you remain overweight on materials, and materials so far year to date have been kind of middle of the pack, up about 8.6%, but then you compare that to communication services, up about 24%. What is going to be the catalyst for materials to maybe bump up that leaderboard?
So, I think materials has been interesting to us for a number of perspectives for a while. When we did our mid-year sector outlook, we actually did a survey of our analysts, and we found that the enthusiasm level there, despite all the challenges of tariffs, was pretty high relative to what we saw against other sectors. We don't ask our analysts to identify catalysts specifically, but we do look at things like valuation, we look at demand levels, and our analysts recognize that there were demand challenges, but we also know from our quant work that you get a benefit from a weaker dollar. We've also looked at the valuations, and I think they still look, pretty cheap on certain metrics, reasonable on others, but we're really not seeing a valuation problem. If I say compare that to industrials, which did very, very well off the Liberation Day lows, they've been trading, somewhere between 2 and 3 standard deviations above the long-term average on both absolute and relative PEs. So I think at a certain point, you look at a sector like materials and say, look, if we really want a broadening trade in the market, if we really want to see some of these areas that haven't done quite as well catch up, that seems like a pretty decent place to look. And yes, there is tariff risk there, but again, when we go back to our analyst survey, they assessed policy risk higher in areas like consumer discretionary, consumer staples, and even healthcare. Materials was kind of middle of the pack on that basis. And if you look at earnings revisions in that sector, in part boosted by the weaker dollar, they're in healing mode. They're not off to the races like some of these other sectors, but they are headed in the right direction.
All right, Lori, we have to leave it there. Lori Calvasina is the head of U.S. equity strategy at RBC Capital Markets. Now, we will get back to what's going on in financial markets in just a second, but we want to go to the world of politics. There are various news reports out right now that the conservative activist Charlie Kirk has been shot at an event in the state of Utah. Charlie Kirk is, of course, the executive director of the conservative activist group Turning Point USA. He was at an event at Utah Valley University, according to multiple reports, including from CNN as well as the Associated Press, saying that he was shot. Kash Patel, the current FBI director, in a social media post on X, says that, quote, "We are closely monitoring reports of the tragic shooting," and says that their thoughts are with Charlie. We'll try to get you some more information on this. This is a fluid situation and a lot we don't know at this moment, but we will bring it to you as soon as we can. This is Bloomberg.
We're keeping an eye on shares of Klarna making its trading debut today. The buy now, pay later platform stock opening at $52 a share in a $1.37 billion initial public offering. It's yet another peg in the 2025 IPO wave that has seen billions pour into the likes of CoreWeave, Chime, and Circle. Let's bring in Bloomberg's Bailey Lipschultz, who has been closely following this story. So Klarna, of course, was the one to watch this week. Talk us through some of the reception thus far.
Yeah, we saw this deal priced at $40, so $3 above the marketed range. That's a good sign. We reported that it was about 25 times oversubscribed. Another good sign for investor demand. But Katie, as you mentioned, we see shares open $52, up 30%, now only up about 15%. So you're seeing a lot of appetite for IPOs. The big question, obviously, is will it open stronger, and will that last not only for day one, but week one? And that's something that we tracked with Figma, with Bullish, with Circle, all which opened up more than 100% on day one, but then have drifted from those highs.
And we should point out, I mean, historically, we've seen similar patterns, particularly with companies that have gone on, stocks that have gone on to be some huge money makers. Of course, in the past, we always talk about how Meta, Amazon, even the old Google were more or less flops right out of the gate. But then, of course, no one would argue with what they've become. There's some other names, though. I mean, Klarna came to market in a pretty healthy position in terms of its balance sheet, its income statement. You have companies like Legence. You have a crypto firm from the Winklevoss twins also supposedly coming to market. Do you think we're going to see the same reception for those names that we saw for Klarna? Well,
there's a big question. You mentioned Legence. So how are investors kind of dealing with their appetite for levered PE plays? That's going to be its own kind of beast relative to a Gemini deal, which they came out and said they want to sell 30% of that IPO to retail. So you have crypto, you have the Winklevoss twins, you have a lot of kind of things that would lead to a big pop potentially. That sets it up very different than Legence, or even when we look towards next week, the likes of a StubHub or a Netscope.
It's good context there. There's a lot of different nuances to these different companies that are taking the stage this week. I want to talk a little bit more about Klarna and the fluctuation in this company's valuation, because right now it looks like the valuation is maybe $20 billion, maybe a little bit more than that. Was as low as $6.7 billion in a funding round this year, was much higher at one point.
Yeah, north of $45 billion, I believe, back in its 2021 peak. The big thing, though, when you talk to private investors is who's cutting the check and at what price. This is the big debate. Obviously, OpenAI is in its own world. It's able to raise billions of dollars. That's not a normal thing. So the big thing with a Klarna is, sure, the investors who paid, I don't know, more than 2 times what it's worth now are sitting deep in the red, but the vast majority got in before that and are sitting on pretty nice gains. Even those who got in at the most recent round are still up quite a bit. The big thing is, unless you sold on the IPO, you still have 6 months before you can start to monetize that. So that's really the big question, where it's going to go then, because as I mentioned, we saw Figure close up 250%. Well, now it's up closer to 60 or 70%. So it's a really volatile game right now with IPOs.
When we get to this idea, though, of the secondary trading, and you mentioned, of course, the idea of, at least with the Gemini space, the idea of kind of maybe allotting a lot more directly to the retail investors. We're going to speak with the head of Robinhood, of course, which has sort of been at the forefront of that. And we saw that with the Bullish IPO as well. Do you think we're going to see more companies sort of do that, kind of find a way to sort of just kind of put the institutions to the side as much as they can?
I think it's a conversation. We reported on Monday that banks are actively thinking about that. In this meetings that I've had since, every banker has said, we're trying to figure out the right allocation for retail and what that means. Because if you, I don't know, shut out the likes of a Fidelity, the big point of selling them shares is they're going to buy in the aftermarket and they're going to buy if your stock pulls back. The question with retail is Are they going to flip it? Robinhood punishes you if you do that within the first 30 days.
Right.
But are you really going to show up if it breaks IPO or when you come back to market 6 months from now looking for fresh capital? It's a big question in whether these are just thematics at play.
All right, Billy Lipschultz all over the latest entrance on the street, and that is Klarna, the fintech. A sale last night, IPO at $40. It opened today at $52, at one point reaching $57 a share, now trading at a roughly about $46. Well, when we come back, we're going to talk about the star of the show. No stock is doing better today than Oracle. Those shares having its best day since at least the 1990s. The old school software company as well, now a new economy AI play. That conversation coming up after the break. This is Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. And we start today with Nike. TD Cowen upgrading the stock to buy from hold, lifting the price target to 85. The firm bullish on turnaround progress at the footwear maker thanks to new management and, well, additional signs of improvement when it comes to the Jordan brand. Those shares higher by about 0.5% on the day. Next up, Newmont. RBC raising the gold miner to outperform, boosting the price target to 95. The record run in spot gold prices, that was behind the upgrade for Newmont as well as some of its peers. But the analyst says Newmont is the better tactical play. Those shares up about 4% on the day to their highest since 2022. But let's talk about the stock of the hour and, quite frankly, well, maybe the stock of the year, Oracle. Citi boosting the software company to buy from neutral, nearly doubling the price target to 410. The upgrade coming after a blowout earnings and, more importantly, blowout guidance. Guidance that has now pushed the stock higher and has made Larry Ellison, for the first time, believe it or not, the richest man in the world. Joining us right now to talk a little bit more here about what comes next for Oracle is Tyler Radke, co-head of U.S. Software Equity Research at Citi, as we continue to see those shares push higher, up more than 35% here on the day. And Tyler, this was less about, I think, what happened in the last quarter, but really that guidance about the cloud infrastructure unit, a business that, you know, what are we talking about, $18 billion in the most recent year, and a company saying that within 4 to 5 years, that's going to be a $100 billion business?
That's right. I mean, this quarter was kind of unbelievable, the numbers that they put up. Now, not so much on the revenue side. The revenue was basically in line with expectations, but the backlog, or the RPO number, was just hard to even fathom. I mean, it's over $330 billion of new signings in a quarter. I don't think I've ever seen a number that big out of really any tech company, really in history. So, I mean, these are massive numbers. Obviously, there's a long duration to these, so these deals are going to take a while to ramp up. But you combine that with this really strong cloud revenue guide, numbers are going up dramatically. So you mentioned, we did double our target price, but guess what? Our revenue numbers for FY28 and our earnings numbers for FY28, they went up by almost 30%, which is just pretty amazing for a company of this size. And so.
Can you explain kind of what the magnetism is right now for clients to Oracle? Is it that their expertise is sort of the only game in the town, or is it just better than everyone else's?
Yeah, it's a good question, right? So I think they're not the only ones benefiting, right? You're seeing a lot of AI strength at Microsoft. You're seeing it at some of the neo clouds like CoreWeave. You saw a large deal earlier this week announced with another neo cloud in Microsoft. So I do think that this is a rising tide. Oracle does have some unique advantages. So if you go back to 10, 20 years ago, they bought a hardware company, Sun Microsystems, which was kind of viewed as legacy tech back in the day. But they have a lot of special secret sauce around the interconnects, being able to really optimize data centers to run these large-scale training clusters. And they also have a unique strategy in terms of being able to operate a lot of these across the world. So they have the highest number of localizations in terms of actual locations. So if you're a demanding customer that needs that low latency, they can set up shop close to you. So it's a little bit more modular. And I think the big thing here is what we saw in the operating income guide for this year and for next year is that the profitability is also showing through. So that was one of our concerns, is just, hey, they're getting a lot of revenue, a lot of bookings, but what about profitability? Again, our EPS numbers went up by 30%. And so the $400 plus target price, that's still kind of a mid-30s multiple. on our 2028 EPS number.
And so, Tyler, I hear what you're saying. Clearly, the fundamentals are here, and Oracle knocked the cover off the ball when it comes to some of the expectations. But even still, you take a look at the share reaction right now. I mean, it's stunning, up 35%, its biggest intraday gain ever. And this is a mature company. It's been around since the 80s. Is there a possibility here that this move is overdone?
Well, look, I think it's a big move. Obviously, it's a great day to be Larry Ellison. But, you look at this backlog number, which this backlog number is something that I report every quarter. It literally tripled from one quarter to the next. So they added, over $330 billion of contract value. So, yeah, the stock's up a lot. I think it's still, in terms of market value, still might be up less than that, incremental backlog that they added. So, again, it's up a lot. But again, we don't think the valuation is particularly stretched. Could you see some profit taking? Sure. But again, I think you look to next month. They're hosting their AI World in Las Vegas. They're hosting a financial analyst meeting. We are expecting potentially more upside on bookings and profitability as we get into that event. So really the magnitude of these bookings numbers, I think, definitely justifies the move today.
Yeah, and to your point on the backlog, Bloomberg News points out in an article that their backlog, Oracle's backlog, is roughly 4 times that of Google's backlog. That suggests that their cloud growth rate is poised to surpass that of Google. And Tyler, just to build on that, I have to imagine that what we learned last night does reset the competitive landscape here.
Yeah, it does. I mean, Oracle has been kind of starting fresh in the public cloud, even before AI, right? They were not really a beneficiary from the early days of this build out, with the Azures, the AWS, and the Googles of the world. And so AI is sort of leveled the playing field. And again, as in the years ahead, we're going to see pretty massive growth in their cloud business. But look, I think there's a lot of others that are doing quite well. We cover CoreWeave revenue for them. It continues to grow in the triple digits. I think there's a very optimistic outlook there. Oracle doing well doesn't necessarily mean CoreWeave does poorly. And again, Microsoft is, I think, kind of still the winner in all this. And frankly, some of Oracle's success is coming because Microsoft, frankly, just doesn't have the capacity to take on these deals. All
right, Tyler, great to get some time with you. That is Tyler Radke. He is co-head of U.S. Software Equity Research at Citi. Don't go anywhere. Up next, we have Vlad Tenev, the CEO of Robinhood.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. We're keeping an eye on shares of Robinhood. A lot of news coming out of this company starting last week with their inclusion in the S&P 500.
Yeah, that's officially going to start in about 2 weeks' time here. I think September 23rd, it'll start trading there. But really a ratification of just how far this company has come. And it was really derided kind of in the early days of kind of being this kind of scrappy outside player that was disrupting things. And now it's basically an institution.
Yeah, absolutely. The new Wall Street definitely courting a lot of those younger investors who have stuck with the platform. I remember that being the conversation in 2020, 21, were they going to graduate to the Fidelities of the world? But no, this is a force to be reckoned with. And today actually is Robinhood's Summit 2025 event. And as we were mentioning, there's a lot for the company to celebrate, including that recent inclusion on the S&P 500. And just today, the company announced that they're breaking into the social media world with their platform, Robinhood Social. Joining us now live from that event is Vlad Tenev. He is the CEO and co-founder of Robinhood. Vlad, great to have you with us. So just set the scene for us. Why launch a social media platform on this app? What does this bring to Robinhood?
Thanks for having me. Yeah, it really brings 2 things. One, as we transition from being a trading app for beginners to a comprehensive financial super app, we want to get into, we want to be not just the platform where you can transact and make that trade, but also help with idea generation and provide a new source of information to our traders and investors alongside the business and company news that we already have in the app. So we think this can be a useful source of information. We're already at a large enough scale to where I think we'll get some great insights from traders to the community. The second thing is we think that particularly for traders that want to build followings, that want to share their ideas, we've got a lot of things to offer because we have a unique advantage in that we can make sure that the trades and the portfolios that are being posted on our social platform are verified. And this is something that other social media platforms, be it Reddit or X or Discord, struggle with because they rely on people posting screenshots from the places that they place trades. But since both are under one roof, we can make sure its signal to noise ratio is quite high and that you know that the traders are verified, the performance is real, and there's real money behind some of the things they're saying.
And just as a non sequitur, I will point out that Reddit share is actually up 8% right now at a record high. But turning back to this platform, as you mentioned, right now, it seems like it's mostly about posting trades. All posts have to include trade of equities, options, or other assets, and they will continue to update in real time these positions. But where do you possibly see this going? You mentioned you want Robinhood to be sort of an everything app here. How does social media evolve and fit into that vision?
Yeah, a big part of it is user-generated content. So we're adding more assets for sure. And you mentioned equities, options, futures. There's also prediction markets. And one of the things we demonstrated at our event yesterday was a social conversation around a football game prediction market. So you can imagine that you could be watching the game, trading on the outcome, and connecting with traders and sharing opinions. So I think as we add more assets, it gets much more dynamic. And I think over time, we should see new information and new news being broken on the platform by our traders. And we think this can become an authoritative source of business and financial content. So we have the scale to do it. And it's an exciting announcement in some ways for me because the origins of Robinhood, before we got our license to operate a broker dealer, we were a social network, and this is almost like coming back full circle for me.
It's also kind of gets to this idea, though, too, of making sure that, I guess, the retail set, for lack of a better phrase, just has a little bit more control and maybe a little bit more, I guess, effectiveness in the transparency of financial markets. I want you to talk to me a little bit, Vlad, about how you further that even more down the line than where we are right now. This idea of greater transparency in the market, greater access to IPOs for the retail set that in the old days was basically zero. How much further can you push that?
Yeah, I mean, the theme of Hood Summit, the event that we're at right now, is it's really about making sure that traders on Robinhood, which are a unique set of customers that we want to take very good care of, feel like they would be at a disadvantage using any other platform. And a big part of that is making sure that things that high net worth individuals, wealthy customers, institutions have historically had should be allowed to, should be given to our retail customers as well. So we also announced short selling, which was people were very excited to hear that. We announced Robinhood Cortex, which is our AI platform, being available to Robinhood Legend, which is our professional web platform. So we're integrating more and more AI tools to help people with their trading and their investing. And we didn't announce anything in Hood Summit around private markets, but we've been doing a lot of work there too. And particularly as you're looking at the current landscape where AI is disrupting every facet of our lives, professionally and personally. A lot of these AI companies are private and getting into hundreds of billions of valuation. Yeah. And right now, that wealth is being concentrated among a smaller and smaller set of people. So we think it's important to distribute that and make it available to retail as well.
What are some of the ideas, though, that you've talked about with regards to how that is structured? Are we talking about being able to buy into individual things, or is this more about packaging into ETFs and other sort of instruments that sort of aggregate multiple private assets into one thing?
Yeah, I think there will be both models for sure, and it'll vary a bit based on what's permissible in different regions. So for example, in Europe, just a couple of months ago, we had a similar event to Hood Summit, but it was focused on crypto. It was called To Catch a Token. It was in the south of France. And there we launched tokenization. So we launched stock tokens of public companies, and we also demonstrated through a giveaway tokenization of OpenAI and SpaceX, which is very exciting. So we do have the technology already to make private companies available to retail. The things that we have to get through is really, how do we do that in the US? What's a good product that also fits within the current regulatory construct? And how do we make sure that the companies understand this and are excited about it, and actually, we get the best companies to opt in and join us for this revolution.
Vlad, we only have 30 seconds here, but I noticed that you're not actually in Paris. You're in Las Vegas, of course, at the Hood Summit. A cynic might say that Robinhood is more of a gambling platform than it is an investing platform. So there is some poetry here, and I just wonder if that was intentional.
I mean, not in the way that you laid out. I will tell you, Las Vegas is a great American city. I think that there, in many ways, it's a growing sort of like symbol of where the country is going. It's not just, financial services and entertainment, but really, there's a new economy. And I think it's also just a place where people convene and meet and discuss all sorts of things. So I think that, we feel good about it.
All right, Vlad, we'll really appreciate you taking time for us out of a busy day for you. Vlad Tenev, the CEO and co-founder of Robinhood out there in Las Vegas at Hood Summit 2025. When we come back, we turn to one of the biggest decliners on the day, and that is Chewy. It's our stock of the hour, and it's up next. This is Bloomberg. Keeping an eye on shares of Chewy having their worst day since going public all the way back in 2019. Investors digesting the pet supply company's second quarter earnings. It beat on sales and adjusted EPS, but not enough to allay some concerns about the margin outlook going forward. Diana Rosero-Pena joins us right now. She covers this company for us as a consumer staples analyst at Bloomberg Intelligence. Diana, what exactly is going on here?
Yes, like you said, sales growth was adequate. Second quarter was strong on both ends, both on the on sales and margins as well. But the outlook is not looking good on profitability.
So getting punished here. You point out in your notes that auto-shipped reached a record 83% of sales. I have to imagine that, you would think that would be a big boost, right? People forget that they signed up for that all the time, but not necessarily coming through.
Yes, and this is the way that I look at it. I look at the company now. It's more of like subscription format rather than a transactional format. So 83% of your revenue coming every month, that is a significant scale that you can build long term. But again, I guess investors are looking for that inflection point in the industry. You're looking at Petco, you're looking at Freshpet. All of these companies have been reporting okay sales, okay margins, and they're still being battered because consumers do not seem as enthusiastic to spend on their pets as they used to.
Oh my gosh, how dare you?
Speak for yourself.
I know, yeah, you haven't met my dog. she demands to be spent on. But she's a bit of a diva. But I am curious, though, about just this idea of what's special about Chewy. And we've had the CEO on before. We've talked about this with them. We've talked about this with Petco. The idea is that they're all kind of selling a lot of the same stuff. And I am curious as to what is the advantage of being a customer and being loyal to Chewy rather than just going to Amazon or Walmart or Petco or whatever the other options are out there?
So I would say that Chewy positions themselves as a specialty retailer, but that you can contact at any time. And it's very convenient, and it brings your items to your door, which is a significant driver for auto ship for sure.
But so does Amazon. I have to imagine, and we don't have much time left, though, that Amazon is just the albatross for this industry as well.
Yes, but consumer service that they provide might not necessarily be as strong as Chewy does.
Yeah, fair enough. Diana, great to get some time with you on what a terrible day this is for Chewy. That is Diana Rosero-Pena.
You have pets, right?
I have a cat, and I feel like I'm spending more money than him on
I mean,
ever
who are these
before.
people who are saying I'm not going to spend more on my pet?
I don't love my dog as much as I used to. Yeah, but I do think, I don't know, I buy food from Amazon. It just feels like Amazon is taking over every industry, including human grocery as well, which we've learned in the past few months. So.
Yeah, absolutely. I buy it, by the bulk.
By the bulk. All right, coming up, we are about 15 minutes away from the closing bell. We'll take you there with Lizanne Sonders. She is Chief Investment Strategist with Charles Schwab. That conversation coming up next. This is The Close on Bloomberg.
And we've told people, if you look at sort of the rate cuts, people have wanted to get so bulled up on these more cyclical parts of the market. We've said, look, if you look at the cuts, those tend to be sort of short-lived boosts. And we do worry that the kind of lackluster fundamentals will ultimately catch up with you. So I think that's part of why, frankly, Romaine, even though this market is making new highs, it's creeping up to them very, very slowly.
RBC's Lori Calvasina kicking us off to the close just about 50 minutes ago. A market in a bit of a holding pattern. We saw a lot more green on the screen earlier in the session. Most of the indices have given up their gains, though, as we get closer to the close, though. The S&P holding the line, largely because of Oracle.
Yeah, it's really one of those days where it's way more interesting under the surface than it is at the benchmark level. The S&P 500 a little bit higher. These incremental gains we were also talking about with Lori, the slow march to record highs. The NASDAQ 100 unchanged. Oracle is not in the NASDAQ 100. That is my fun fact of the day. The Russell
It is a fun fact. Do you have a fun explanation for that?
I do,
Because
actually.
I was very surprised by why.
I'm so happy you asked. In 2013, Oracle switched its listing from NASDAQ to the New York Stock Exchange.
There you go.
Thus is not in the NASDAQ 100. So all those investors in NASDAQ funds today, obviously missing out, but it all comes out in the wash. Anyway, the Russell 2000 down about 0.2%, even though we got some decent PPI data this morning showing inflation, at least at the wholesale level, declined a little bit. And despite a big rally in the bond market, 10-year yields down about 4-5 basis points.
A mixed day in markets as we move closer to those closing bells. Lizanne Sonders joins us right now, the Chief Investment Strategist with Charles Schwab and Company. And Lizanne, I do want to start off just first with the tech and AI trade. I think a lot of people are looking at Oracle's results last night as ratification of this big AI spend, or at least ratification that spend should continue for the foreseeable future. Does that give justification to the valuations that we've all been wringing our hands over the last few months?
I guess it depends on the individual name. If you look at any kind of collection of AI-related names, you are looking at fairly lofty valuations, but at the individual stock level, they're not as extreme. And obviously, the trajectory from both the top line growth and bottom line growth has been seen as justification for larger than sort of average valuations. I think the key on a looking forward basis, given that the forward PE tends to be more in focus than trailing, is whether that the denominator in the equation can maintain itself. And I think from a spend perspective, what recent news has highlighted is the continued bifurcation in terms of the investment side of the economy, the CapEx side of the economy, kind of this K-shape of AI or AR related and AI and AI related. You've got such a constraint on CapEx and CapEx intentions because of uncertainty with regard to trade, but that so far has not been an infliction on the AI related names.
There's been a lot of discussion about the rally, or at least a lot of the upside moves that we've seen in the market over the last few months, and how a good chunk of that seems to be driven more by the retail side of the investment landscape rather than the institutional side. Is there an explanation why you still seem to see that enthusiasm from the retail set and that reticence, if you will, for lack of a better phrase, by the institutions?
So I would segment it further than just retail. I think it's the retail trader, the specific trader that was born out of the pandemic. They tend to skew on the younger side. They tend to skew more male. They're very much believers in buy the dip. They don't tend to be long-term fundamentally driven. And one way to track how much influence they're having in terms of what's doing well and what's not is not just what they represent in terms of average daily trading volume, volume. Estimates are somewhere in the 20 to 25% range for that metric. But segments of the market that have been doing particularly well. And there's a whole bunch of baskets that we track, many of which are, Goldman Sachs baskets that you can get, ticker symbols for on Bloomberg, as well as a particular meme stock basket that is tracked by UBS. And it's the meme stocks, it's non-profitable tech, it's heavily shorted stocks. Those are the baskets that have been performing particularly well off that early April closing low, specifically on April 8th. And that's just another proxy for these retail traders, suggesting that they've been sort of in full force. Now, that buy the tip mentality, quite frankly, has been the right move in their time horizon or the span of time where they've become a more powerful cohort, which again goes back to sort of the post-pandemic period of time. So they've been right. But it does suggest that there's a bit of complacency that maybe is sort of this peripheral risk.
Well, you make a good point that in the grand fullness of time and maybe even shorter time frames that stocks generally do go up. This rings parallel to a conversation we were having with Frank Monkham actually yesterday, talking about how you do have this buy the dip mentality when it comes to stocks, fueled in part by these retail investors who maybe got in the markets in the pandemic and never left. And he used that as a reason why you're seeing bonds and equities behaving in such different ways, because it's true, you don't have this same retail participation that you do in equities in the bond market, Lizanne, and I wonder, what you make of that argument.
Yeah, no, I think that that's absolutely valid, and why on a number of metrics where you do comps between the bond market and the equity market and where correlations are tightest around whether it's the yield curve or individual yields like the 10-year yield, credit spreads. At times, there appears to be a pretty meaningful disconnect between what's going on in the stock market and what's going on in the bond market. And Katie, I think to that point, some of it has to do with who the dominant players are within these markets on a short-term trading basis. And I'm not sure that the retail trading cohort is keying off some of the messages emanating from the bond market, like might have been the case in the past when you had a more institutional driver from a cohort perspective of the equity market.
Well, I personally would love to see the meme crowd come to the Treasury market. I think that would be a really fun time. But we're a week out from the Federal Reserve decision. It seems like 25 basis points locked and loaded when you take a look at the pricing. But then you think about the PPI that we got this morning. You think about the CPI that we still have yet to see. Do you think there's any case for the Fed to cut 50 basis points here?
Not really. You didn't see the needle move much on the PPI data. I suppose if you got an extreme move to the downside in CPI, you could see those market-based odds go up. But I think the best guess at this point, barring some shocker out of CPI, that the Fed moves by 25 basis points, and that's generally the expectation for the remainder of this year. The market now has built in 3 25 basis point cuts over the remaining 3 meetings. I think what will be key in terms of what becomes market moving is not maybe the probabilities around what the Fed does and the size, but what the long end does. I think that's where you can see the inflation data move the needle a little bit more. You think back to just a year ago when the Fed cut by 100 basis points and the 10-year over that same span went up by 100 basis points. So don't just pay attention to what the Fed does, watch what the long end does.
Lizanne Sonders, Chief Investment Strategist with Charles Schwab and Company, counting us down to the closing bells here on this Wednesday afternoon. A push higher into the green as we get closer to those bells with the S&P perched at a record high. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell with the global simulcast, and it starts right now. Jess Metten in the radio booth, Lisa Mathieu by her side, Carol Masser and Tim Stenovic taking a well-unearned day off here on this Wednesday afternoon. Welcome to our audiences across all of our Bloomberg platforms. A record-setting day potentially here, Jess, for the S&P 500, though. a somewhat tepid one.
That's right. I did see a post from Carol, though, on Twitter earlier this week, X rather. She was getting some sunshine at the beach, but of course, to your point, Romain,
yeah.
looking at those producer prices falling to the lowest level since we saw back in April, but looking at how that's boosting the S&P, still trading with 6,500. Lisa.
All right, and this, of course, all comes after that surprise decline, right? U.S. wholesale inflation declined in August for the first time in 4 months. That's according to BLS. So the producer price index decreased 0.1% from a month earlier. So if we look at the yield space, the 2-year 3.54%, that's down a basis point. The yield on the 10-year 4.04%, that's down about 4 basis points.
That's the thing. It seemed like that was it caused a bigger ripple in the bond market than it did in the equity market, even though you had all this excitement on the day when it relates to Oracle, which I know we'll talk about. But again, comes back to tepidness, as Romain said.
Yeah, and we should point out that most of the strength that we're seeing in equities today is basically that ripple effect from Oracle. Oracle, obviously, the biggest gainer on the day on a percentage basis, but of course, that's providing some fresh breath into names like NVIDIA, like Broadcom, as well as, of course, a lot of the energy players in that space that are being tapped, of course, to help power this AI infrastructure build out. The clapping begins and the bells start ringing here on this Wednesday afternoon. Green on the screen for the S&P 500, 65.32 and change as we wait for those numbers to settle. But no matter how they settle, it will be in the green, and that will be yet another record high. The NASDAQ composite looks like it's going to close the day basically unchanged. It looks like we're going to get a green arrow on it, up about 5 points here on the day. And I just want to double check because the NASDAQ 100 also closing in the green, but only by about 9 points. But that is good enough, believe it or not, for a record high. The Dow Jones Industrial Average is in the red, as is the Russell 2000. The Russell, guys, down 4 points or 0.2%.
Taking a check at advancers and decliners, around over 180 companies higher today, about 37% of the index, and 316 lower, or 63 roughly percent. Katie.
And let's take a look at the sector level. Interesting breakdown here. You had slightly more losers than winners when you take a look at that circle. But if you're wondering what that bright green area is, that, of course, is tech. We know it was a big day in the tech space, Oracle again, but also energy having a good day as well. Utilities, too, getting in on the action. What didn't do so hot today, consumer discretionary, your biggest loser on a percentage basis. Consumer staples as well, having a bad month and having a bad day, down about 1%.
And of course, looking at the gainers, guys, have to bring up Klarna, the buy now, pay later. Of course, we had Bailey Lipschultz in here earlier breaking it down for us. So looking at how it priced its IPO above its range and raised about $1.4 billion. So at the open, rising as much as 30%. And of course, Katie was just mentioning Oracle, OLCL here for the ticker, actually jumping at 36%. So it's the best day since December 1992. So the Wall Street Journal having that report that OpenAI signed a contract to purchase $300 billion in computing power over roughly 5 years from Oracle. And then you're looking over at other companies related to that. So Broadcom, up close to 10%. It's best day since April 9th. So rising on the back of that. So it's kind of leading the chip sector rally there with its CEO actually talking about a potential for a big payday if he can hit challenging new targets for artificial intelligence. And then asset entities, the ticker is ASST. That's jumping, looking at 29% higher. Its best day since August 11th. And so what happened here, its shareholders did approve a Strive merger here. So looking at that stock more than doubling when you're trading there and seeing how that shakes out for the gainers there. So Lisa, what are you looking at for decliners?
Okay, decliners, I have to go to Synopsys, ticker SNPS. Their shares closed down more than 35%. A big downer. It warned that U.S. export restrictions are contributing to a slowdown in China, and that is its largest market for semiconductors. So its CEO said a couple of things. He said he would be refocusing those resources on other areas. They said they're reducing the company's headcount by 10%. Also reported things like third quarter results, showed a weak read on design IP revenue, gave an earnings outlook that was a little bit weaker than expected. I also want to point out Chewy, ticker CHWY, their shares closed down about 16%. So basically what this is, it's going to give up some profit to get a larger share of the pet supplies market. That was, even if it meant disappointing Wall Street, which it did. So it reported those second quarter results, raised its full year sale guidance, but the company backed its profitability outlook, right? It plans to reinvest those top line gains into pricing seeing growth drivers like its paid membership program. I don't know. I don't have a dog. I'm allergic. So there you go.
Oh.
Sorry. TMI. I know. My kids ask me for dogs all the time. It's not going to happen. I quickly want to touch on HP, ticker HPQ. Their shares closed down about 1%. Basically, this is an upgrade-downgrade story. It was downgraded to inline from outperform at Evercore ISI.
Yeah, let's go take a quick look at yields right now. Basically, a drop down the curve with actually more of the activity on the longer end of the curve. And this is actually going to really play into this idea as to what's been going on with regards to inflation. That PPI report this morning, while on the top line, it did seem to show that there was some containment in the space. We should point out under the hood, when you look at wholesaler margins, you have a lot of wholesalers eating the cost of those tariffs. That means they're not passing it down to the consumer. That might bode well for the CPI report tomorrow morning. But the big question is, how much longer does that last? I do want to turn back to stocks. And before we move on to what happened with Oracle, I do just want to mention Klarna, of course, in the close on the day there. We did get a close right at that 45.82 level. So relatively successful day for the newest entrance to the market, an IPO at $40 and open today at 52 and a close just below 46.
Yeah, I'm really excited to see whether that pop extends to tomorrow and, of course, the days that follow. But let's get back to Oracle, and let's talk about Oracle through the lens of Larry Ellison, because the redhead hit the terminal this morning that Larry Ellison has become the world's richest person on the planet for the first time, ending Elon Musk's nearly year-long reign in the top spot. Now, a lot of his net worth is tied up in Oracle. We know that. And I mean, you think about today's gains, I think that netted him a cool $101 billion. So all told, that lifted his total fortune to about $393
I think what's so interesting, two things I found interesting. A, that he's never been atop the rich list in all these years. And remember, Oracle was kind of the premier, at least for data software, way back in the days. So it's kind of interesting to see that for a guy who's approaching 80, for a company that is, 48, 49 years old, that now, after all this time, he finally gets his flowers, all because of this ChatGPT.
It could happen to any of us. Any of us.
Could it really? Can it happen to me like today?
Yeah, come on. Or maybe.
I mean, I love you guys, but you know.
You have to wait until you're 80.
Why would my island in Hawaii?
Yeah.
How can I?
Well, Lisa and I actually had Christine Oram on. So she's the Wealth America's team leader here at Bloomberg News.
Where does she
talking to us
rank on
about
the
that.
rich list?
Right, so the rich go in the function of the terminal. It was interesting, her kind of giving the context of what you were just talking about, Romaine, but then also potentially it might be a little bit short-lived that he's at top of the rankings, depending on just the massive, and when you're thinking about Elon Musk and how many companies he does own, but of course pointing out Tesla stock still lower, down at more than 10%.
Yeah, and the whole back and forth about who's been, having the title before, Amazon, Jeff Bezos, and LVMH's Bernard Arnault, and the whole back and forth of what happens. I mean, Elon became the first time 2021, so now the torch is handed off to yet another.
And also just for our viewers here, I mean, this report, we talk a lot about just the big pop in the stock and, of course, the wealth creation for Larry Ellison and his family. But we should point out this really was a ratification of a lot of the CapEx spend that we've seen in this space. And if you believe those numbers, there's a lot more to come. And it's a big part of the reason why you saw the CoreWeaves and Dells and HPEs and pretty much that entire AI ecosystem move higher. One interesting note, though, if you look at the application software companies out there, they all plunged today. Oracle's old business, that data software business, that's actually in decline. I mean, I'm sure they're fine with that, but also something to keep an eye on there. All right, that does it for our cross-platform coverage of the market close on Bloomberg Television, Bloomberg Radio, as well as our partnership with YouTube. A reminder, Bloomberg Business Week is now on Bloomberg Originals. Radio will be back tomorrow at the same time and at the same place. Meanwhile, our coverage continues here on The Close. We're going to talk about those PPI numbers, those producer price inflation numbers that we got this morning, which sets the stage for those consumer price numbers that we're going to get tomorrow. And of course, a big Fed meeting that's just about a week away. Lauren Goodwin, economist and chief market strategist at New York Life Investments. She joins us after the break. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. You're seeing a drop in yields here on the day ahead of another inflation report, ahead of a big Fed meeting in the following week. But stocks, at least the S&P 500, did manage to push higher to yet another record high, 65.32 and change, only 0.3% higher. But I think a lot of folks will take it. Of course, a big sort of impetus for that move higher for the S&P 500 were the results that we got out of Oracle. You see the semiconductor space having a phenomenal day here. All of the big players in that space, your NVIDIAs, your Broadcom, all moving higher here on maybe some ratification of the idea that there is still a lot of life left in the AI trade. But one interesting thing I thought coming out of that Oracle report was one of its legacy businesses, that software business. You saw a lot of the application software companies actually move lower because that business isn't doing well, though. Based on the move in Oracle today, I don't think they care.
Yeah, I don't think it's surprising either that I have Oracle on the board behind me, because take a look at this move. Oracle shares soaring, up 36%. I believe that's the biggest move since 1992. And this whole board, actually, we were breaking these numbers this time yesterday, of course, reporting after the bell. So Oracle, clearly the star of the show. Rubrik, I can't say the same, down about 18% or so. And then Synopsys, this is the mirror move to Oracle, as you can see, down almost 36%. That is the biggest fall for Synopsys in 3 decades. And it comes back to the trade war hampering sales of Synopsys. So really, it just goes to show that you can't paint broadly here, Romaine, that there's certainly some huge winners and certainly some big winners, or losers, rather.
Absolutely. And that actually brings us to our top story of this hour. Katie, you want to take it me
Let me do that. Let me walk over here to tell me.
You know, Katie is new to this show. We got a lot of choreography here, Katie.
Yeah, we do. There's a lot of dancing, and I'm just getting my feet under me. In any case, it's Wednesday, and that means that there is 1 week until the Federal Reserve decides, with fresh inflation data reinforcing bets on a rate cut. You saw wholesale inflation unexpectedly decline in August for the first time in 4 months this morning, and now investors turning their attention to tomorrow's CPI print. Our next guest says that there's almost nothing from that report that would keep the Fed from cutting 25 basis points. Certainly some fighting words.
All right, let's bring Lauren Goodwin into the conversation. Economist, chief market strategist at New York Life Investments. You just heard her reference you, not by name.
Fighting words.
Fighting words. A lot of pressure on you. I am curious, though, in all seriousness, like, what did you make of it? Because we looked at that PPI report, and the first thing everyone, it's like, oh, great, this isn't as much of an issue. But then when you kind of look under the hood, it does seem to be that there are some price pressures, upward price pressures there, but not necessarily enough to really sort of alter, I guess, what we see at the consumer level. Is that the way to look at it?
That's mostly the way to look at it. I've been thinking about this in layers effectively. Like, the headline message from this report is that it makes it much less likely that we see a major upside surprise in CPI tomorrow. And from my perspective, there's all systems go, clear path ahead for the Fed to cut 25 basis points next week. Take it a level lower, and in addition to the PPI data being pretty regularly volatile month to month, there are price pressures building in areas that are most impacted by the policy changes that we're seeing, from trade to including some immigration realities with wages and the like. And so, though we are confident that we'll see a cut next week, and frankly that it's the right thing to do given the dynamics we're seeing broadly, it doesn't, to me, suggest that we're beginning a consistent rate cutting cycle after that September meeting.
What would, in your view as an economist, justify the start of a consistent rate cutting cycle?
Not to be incredibly boring, but there's a couple of things the Fed looks at, right? They look at inflation, they look at the labor market, and I think the tiebreaker is financial conditions. On balance, in this last few months, when the data has been pretty mixed in terms of the upward and downward pressures on the labor market and inflation, financial conditions has really been our swing vote with respect to what the Fed could or should do next. And with equity valuations, bond valuations, credit availability really quite good in public and private markets, there's not a lot of reason we see to suggest that the Fed is all of that restrictive right now. And so that's really the swing vote that we've been watching to say, probably not yet.
That's interesting to hear you say that, because the administration obviously has the opposite view, that things actually are quite restrictive when you take a look at where rates are set right now. And I mean, you think about what 25 basis points will do. I mean, will we even feel that? Where in the economy needs just 25 basis points here?
So I think this question is so important. And one of the key things we've been discussing and debating as a team is, given what 25 basis points does and doesn't do, specifically, is it enough to improve confidence economy-wide? Because to your point, 25 basis points, good news for borrowing rates that are set at the short end of the curve, and that includes many elements of private credit or direct lending. It's good news for some areas of consumer credit. It's a cycle extending in a way. Good news for financials because it probably steepens the curve. But anything that's priced on the long end, housing as an example, is unlikely to see a big boon from this 25 basis point cut. And so our view is that you probably do get a meaningful boost in confidence just from the Fed moving towards a rate cutting cycle, but that the real cost of capital isn't, again, it's not a done deal that that's moving lower than this 25 basis points.
Well, Lauren, let's go back to your fighting words. And I call them fighting words because the phrase, there's almost nothing that we could see tomorrow that would keep the Fed from cutting 25 basis points. Now I just imagine, the most extreme example. But what would be more surprising to markets at this point? To see the Fed not cut at all, or to actually go with the 50 basis point cuts that some folks in the market are talking about? I think that the bigger impact would be, and in a negative way, actually, would be for the Fed to do a jumbo cut, to move 50 basis points or more. And again, I don't think that that's a likely scenario because I think it would be so impactful. And the reason I say that is, with, as I mentioned, financial conditions so loose, with inflation balancing out, but still, forward-looking pressures are still very much in the mix. Long-term inflation expectations haven't been moving lower. This is an environment where the data supports a cut, but doesn't support panic. And credibility is one of the most important, if not the most important policy tool that the Fed has. And so if you see the Fed moving more than the data might support, then I think you might see long rates move higher even as the short end moves lower. That's something that I think would be, frankly, not the outcome that the economy or the administration's looking for.
But there does seem to be a sort of a sense in the markets that one way or the other rates are going down, if not because of the economic data, but because of the potential changes that are coming to the Fed board. It looks like Stephen Myron's nomination does look like it is likely to go through and that he could even be there for the next meeting. And of course, we know one way or the other, Jay Powell will be gone in a few months' time.
That's right. And look, the Fed, I firmly believe the Fed is not partisan, but there is a political reality that changes that the Fed is aware of. I don't think that's playing a significant role in decision making today because the data does support, I think, some, let's call it insurance with respect to the labor market. But this political zeitgeist is real. And it's something that the markets will be grappling with right now because we haven't seen big moves to the upside on long rates. The market isn't concerned that this interference is de-anchoring inflation expectations, but that's what we'll be watching. All right, Lauren, great to get some time with you as we count down to that Fed decision. That is Lauren Goodwin. She is economist and chief market strategist over at New York Life Investments. And coming up, a conversation with NBA champion Tristan Thompson about his recent investments and how he's making his mark off the court. That's next. This is The Close on Bloomberg. Well, our next guest is not just scoring on the court, but off it as well. Tristan Thompson, NBA champion and entrepreneur, joined us earlier today to discuss his recent business ventures in AI, crypto, and how he's building a legacy on and off the court. Let's take a listen.
It's important for athletes, and I think in sports in general, right? I think people do it's very disappointing and sad that they try to pigeonhole us as athletes. Obviously, God has blessed us with amazing talents and abilities, but we're more than that, right? We're more than just athletes. We're actually business ventures, we're VCs, we're our own entrepreneur, and I think that's the best way to put it. And for myself, 14 plus years in NBA and still playing and playing at a high level, you look for what's next, right? What's next in life, but how can I make an impact, right? And, obviously a lot of athletes, whether they go into commentating, they go into coaching, scouting, but for me, it's like, how can I partner with companies that are about making a change in the world, and how can I be an asset to help them do that? And I think with these titles and these companies, they all have a special place in my heart where it ties back to my everyday life.
When you talk about how it ties back into your everyday life, one company that you're involved with is a company called Axendow. Basically, it is, you can kind of explain it for us, AI, but through the lens of sort of health equity or having a better understanding of your health and your health data.
Being Canadian, being from Toronto, everyone knows that healthcare is universal. But what about universal? It doesn't mean it's the greatest. It doesn't mean it's the best. And it wasn't really until I was able to make the MBA and have the resources and opportunities to actually have my brother meet these other doctors, and especially UCLA, I give them a lot of credit, and they were able to take my family in and really run tests on Amari. And what they were able to find out is that, you know, his form, the level of epilepsy he had, right? Before then, all of Amari's life, we never knew. We just said, you know, you can grow out of it. They just gave us very general data. But it wasn't until we got to UCLA, and he said, you know, unfortunately, all the tests and the trials that they ran on your brother gave him brain damage. And it was unfortunate. He said, you know, if I met your guys' family maybe 5 years prior, I could have gave treatments that might have given them a better form of life. And for me, that was like a trigger to me that how can I help the next family behind me not go through the same experience that I'm going through? And with AI and having your health in the palm of your hands, you can find treatments and have doctors from all over the world have access to your health data, right? And that's something for me is that I'm trying to help the ones behind me, but even the people that are going through this each and every day.
Looking at, you know, your background and your portfolio in particular, that there's this broader trend of AI founders and crypto founders. The lines are increasingly blurring, and it seems like the skill sets are similar, and you're a great example of that.
Yeah, no, I think that's why we're able to do this, right? With it being on chain, and the great thing about being on chain is that you can see everything. There's no hidden agendas, there's no secrets, there's no backdoor, which obviously for most human beings, before obviously with the administration and them pushing the narrative about, you know, Web3 and crypto, a lot of people were just unsure about it, right? And it had a bad stigma and a bad narrative, whether it was the FTX crash, just bad stories, right? And I think now with everyone seeing these big companies and people are really pushing this on-chain Web3 crypto to integrate to our everyday life, people are educating themselves and realizing that this is actually not a villain, this is actually a partner.
One thing that really caught my eye was this idea that Tracy AI will deliver predictive insights as well. Does that mean that it's going to be predicting which team is going to win the game, basically?
I mean, let's look at our prediction market. That was basically the whole presidential run, right? The Poly market became a big billion-dollar company just from prediction market. And I think that's the trend that's going on in the world, but it's also the trend that's going to happen in sports. And for Tracy AI, she gives her predictions on who's going to win the game. And even though I created this, when we were in the playoffs playing against Indiana, she was tweeting that Indiana's going to beat the Cavs, and I'm like, I created you, and you're going to go against me. You're going to go against your own founder. But the facts are the facts, and obviously Indiana took us out and eliminated us. But I think that's the next step, where prediction market in sports is the next form. It's not all the way gambling, but it's more just letting people take their chances in the odds.
What are your investments looking like outside of like the direct sort of AI crypto world? I know you've been involved in, was it Cloud Popcorn and Viola and John Elliott, and I'm sure a few other things I'm forgetting. I think a tequila brand as well. 818. And I know some of those are investments that kind of come through some of your family and personal connections. But how deep are you pushing? Much deeper are you pushing into that space?
Yeah, I look at myself as an entrepreneur VC. You know, I had a great exit with Poppy, the healthy drink, so I got in there in 2020, early seed rounds. Actually, it was my agent, Rich Paul, brought it to me. So his connection, so it was great. So and then
Rich Paul, he's everywhere these days.
Yeah, he's everywhere, man. He's working. He's a working man, which is motivating. He's another he's another person that motivates me each and every day, because you know where he's come from till now it's been great. But for me, it's expanding your reach, right? I think that's, you know, when you're put on the stage and you're blessed with a certain career, whether it may be basketball, finance, you got to see what else is out there, right? You can't just, like I always keep saying, never pigeonhole yourself into one thing, because you just never know your true potential, right? Physically, I'm NBA player, athletic, jump high, strong, but my mind has potential to be something else, right? Like be an entrepreneur, be someone that could create something, be someone that can help change the lives of everyday folk.
And that was Tristan Thompson, of course, NBA champion with the Cleveland Cavaliers. But as he just told us, Katie Greifeld, he views himself more as a VC, more as an entrepreneur. And we were going through all the titles that he has. I mean, he's got a lot of business ventures.
He's chief across a lot of different industries here. I am really interested in Tracy AI. I was a D3 college athlete.
Not to brag, yeah.
Not to brag.
Yeah.
It's kind of like being an NBA champion, but disrupting the sports commentary space and also trying to predict how games are going to go. It's an interesting application.
One interesting thing, though, with all his business ventures, there's kind of a current that runs through all of them, and that it is sort of very digital, blockchain focus, AI focus in a lot of ways here. And he really was kind of extolling the virtues of what blockchain can do. He talked about himself being a big crypto investor, a levered crypto investor.
Yeah, we learned that.
Is he going to start a Bitcoin treasury?
That might be coming down the pike, but there is a lot of crossover between the AI space, the crypto space, and of course he is an example of that.
All right. Well, of course, we are keeping an eye on all of the assets out there. You did have a record high on the S&P earlier today, and of course, that was largely driven by some of the euphoria surrounding the results that we just got out of Oracle yesterday. When we come back, we're going to talk retail, we're going to talk Tapestry, and we're going to talk to the CEO. Tapestry, the company behind Kate Spade and Coach, unveiling a $3 billion share buyback today, but more importantly, unveiling a 3-year growth strategy at its annual Investor Day. Shares of the Coach and Kate Spade parent closing the day slightly higher, with the firm hoping to get Kate Spade back to profitability by fiscal year 2027. Pleased to say joining us right now here in Studio 2 is the CEO of Tapestry, Joanne Crevoiserat. Great to have you here.
It's great to be here, Romaine, Katie. Thank you for having me.
One of the more interesting nuggets that came out of the Investor Day was just the phenomenal success that we've seen out of Coach, a brand, of course, that for people of a certain generation, Katie, not you, remember when it was the thing to have. It kind of fell out of favor, but we've seen a huge resurgence there. $5.6 billion in revenue in the most recent year.
Yes.
You're anticipating you can get that to $10 billion. How?
Absolutely. Well, we're gaining momentum in our business, and we told that story today during our Investor Day. We really have transformed our company over the last 5 years, and we're expanding the reach of our brands to new geographies and new generations of consumers, and we're winning with a Gen Z consumer, which you mentioned. And we see tremendous opportunity for growth in all of our markets, but we have a focus on growing in North America, Greater China, and Europe with tremendous runway.
With the recent success of Coach, this is a loaded question. Was that something that you did or your team did, or was that just accidental, that somehow, a bunch of folks on social media decided Coach was the thing and now it's the thing?
We've been very intentional and disciplined in how we've executed this growth, and it really has taken a team. Part of the transformation that we've executed over the last 5 years is to create a culture of consumer-obsessed brand builders. And we support that with an agile, data-driven operating model. So I could go into a lot of comments about how we leverage data and use data across our value chain to make and improve our business. And that allows us to invest in our brands. But it really starts with one fact. Our teams are insatiably curious about our target customer. And our target customer with Coach is a timeless Gen Z consumer. And as we mine those data and all those insights, we're embedding those insights into our organization, and they're taking action on them. So it's this translation of insight to action that is making a difference in our business.
Well, Romaine asked the question that it feels like every brand is trying to answer, and that is, how do you sort of bring in that next generation of consumer? Clearly, you found an answer when it comes to Coach, but let's talk a little bit about Kate Spade. Of course, Coach is the bright spot. Kate Spade has been struggling a little bit recently. I know that you laid out today that you expect Kate Spade to return to growth by fiscal 2027. What gives you the confidence to say that?
Well, the good news is we have a playbook, and we have a playbook that's been incredibly successful with Coach. And we're applying that same playbook to Kate, and Kate Spade has something that's rare. Kate Spade is an iconic brand that lives in the hearts of consumers, and we know that because we do research. We are a data-led company, and the research we do shows us that Kate Spade is top 5 in terms of brand awareness. Consumers know Kate Spade. What we hear from those consumers is that they're not seeing product or experience that are relevant. So our opportunity is an execution. And again, we have a Coach playbook, we have a new leadership team, and we're getting started at applying that playbook and unlocking the vast potential we see for Kate Spade.
So you've got the playbook in hand, but how do you adjust it to the environment that we're in right now? Obviously, inflation is top of mind for everyone. There's a lot of concerns about the labor market and just this overarching concerned that this economy is going to start weakening here and that people will have less money in their pocketbook to spend on pocketbooks. So how do you adapt?
Well, we've been hearing that for a while, and we have seen a market and a consumer that's been choiceful over the last several quarters. We've been talking about this. And where we're winning is where we're delivering innovation that is relevant to our consumers. So that it circles back to knowing your consumer. So as we build the capabilities and understanding of our target consumer and deliver better marketing and better product behind those insights, we're winning with the consumer. And the way we do this is with disciplined, there's investment behind it, but it's disciplined business operations. So we've increased our marketing investment over the last 5 years from what was 4% of sales to now over 11% of sales. And in our Investor Day, we talked about growing that even further. So as we invest in marketing to tell our brand story, we're reaching these consumers, particularly younger consumers, on a consistent basis, cutting through all the noise and hitting them with more relevant messages. And they're responding. They're responding to our marketing investments. They're responding to the innovation that we're delivering in product, which is fantastic. So that's the playbook that we're going to execute, and we are already starting to execute with Kate Spade, with increased investment so that we can cut through with our target consumer. And we're building product that is more responsive to what they need.
Do you have any plans to add any brands beyond Kate Spade and Coach?
Well, we did. I would say last year we had a big acquisition. I think we talked about it, Romaine. And that was blocked by the FTC. But what has happened over the last 3 years is that we have seen our organic business, our Coach business, grow, and we now see even more opportunities. So we see a path for compelling financial returns with our organic business and compelling growth well into the future.
But I am curious just about the structure of Tapestry. I mean, back in the day, this was Coach. Then you had Stuart Weitzman and Kate Spade. I can't remember the exact order. And then, of course, the deal for Capri that would have brought Michael Kors and Jimmy Choo and a few other brands under the house. The idea that there was some value in having a diversified portfolio of brands. Do you not feel that that would provide value for investors?
Well, what we see today in our organic business is a tremendous runway for growth. And what we delivered today in our Investor Day was a picture of growth that delivers mid-single-digit growth, and we believe not just for these 3 years, but well into the future, along with low double-digit earnings growth compounding over time. And what that has meant for us, for Tapestry, it's a compelling capital return story. We generate incredible cash flow because we're consistently growing our earnings and our operating margins. Our operating margins closed at 20%. Our Investor Day targets have grown that by 200 basis points. So we're going to grow our operating margins to 22% or more. And that is an efficient model while we invest back into our brands to allow our brands to reach more consumers, right? That's the flywheel. And with that cash, you talked about at the opening, the $3 billion share repurchase. We're going to return $4 billion to shareholders in the next 3 years through the dividend and share repurchase, which shows that we have conviction in the long-term runway, and we see the intrinsic value in Tapestry stock.
I am also curious to get your thoughts on how you approach marketing. We've touched on some of this already when it comes to attracting Gen Z and sort of engineering to reach that audience, but I keep going back to Sydney Sweeney and what we saw with American Apparel. I know that selling jeans is different than selling handbags, but from where you're sitting as CEO, how do you approach some of those celebrity endorsements and those types of marketing campaigns? Because as we saw with Sydney Sweeney, obviously it can be a high-risk strategy to pull off.
We have a very diversified strategy that's anchored in our consumer and our consumers' values. And we mine this data for our consumer so that we can understand what their values are and how they align with the values of the brand. And what we've been investing behind are our purpose campaigns. So at Coach, we talked about 3 years ago, we launched Expressive Luxury, based on the insight that Gen Z consumers don't think about luxury in the same way Gen X consumers may have. They're thinking about luxury differently. And luxury and confidence to them, they gain confidence through self-expression. So rather than talking to them about something that may be important to our brand or was important historically, we're talking to them about something that's important to them.
But on that point, and that's a great point though, but how do you sort of make that connection, that emotional connection with the consumer? Because it's one thing to say, okay, we're using data, which is by almost definition non-emotional. And then of course you have kind of the old school fashion houses where it was just, you know, the gut instincts of whoever the creative lead was. I mean, what's the balance between that old school way of doing fashion and the more data-driven way of doing it today?
Oh, it's an and I'm glad you asked, because it is true. We're at 85% direct-to-consumer company, so we have a lot of data, and we've got really advanced analytics tools that are helping us evaluate, use that data, and make our business better. But we don't stop at the empirical data. And even consumer surveys, consumers can tell you things that, you know, they can say something, but they don't actually do what they say all the time. We're going one step further, and we're actually going into consumers' homes. We're talking to our target consumer, and we're not just doing this in the United States, we're not just doing this in New York, we're doing this around the world, and we're spending hundreds of hours in consumers' homes. They don't know we're from Tapestry, Coach, Kate. I've been in consumers' homes in London, in China, talking to these young consumers, 26-year-old, 28-year-old, and learning about their life, learning about the tensions in their life, learning about the things they value. And we take those insights back into our business. And that's how we connect more authentically, both with our brand, but also with our target consumer.
All right, Joanne, we have to leave it there. Great to get some time with you. Really interesting conversation. That is Joanne Crevoiserat. She is the CEO of Tapestry.
You know, my mother bought me a Coach bag for my birthday.
I didn't know that.
Yeah, I returned.
Last year?
Yeah, I returned and I got some shoes instead. But I mean, it was a.
Joanne's still here.
I know. Yes, Coach shoes. Right. But it was a bag. I mean, it was, you know, I'm secure in my manhood, but it was a little. It looked a little bit like a purse, and I told my mother that. I love you, by the way.
Gosh, Mom, if you're out there, I think that's a nice present. But coming up next, don't call it a comeback. They've been here for years. Retail brands like Coach, as we've been talking about, and Levi's having a renaissance. We'll keep the conversation going with Mickey Drexler, the chairman of Alex Mill and the former CEO and chairman of J.Crew Group. This is Bloomberg.
We were just talking with Joanne Crevoiserat, of course, the CEO over at Tapestry, a big turnaround there, at least in the Coach brand. Other brands also trying to get their mojo back, including Abercrombie and Fitch, as well as a few others. Our next guest knows a lot about building brands and, more importantly, turning them around when is needed. Mickey Drexler is the chairman of Alex Mill and, of course, the former CEO and chairman of J.Crew. Mickey, great to have you back here on the program.
Can you just say it, Gap?
Gap and Gap, J.Crew, absolutely. We'd always give you your due. I am curious, though. I mean, we're talking with Joanne at Tapestry, and one of the sort of interesting stories over the last year or so is kind of the reemergence of Coach. Not only because of what she did, but just kind of the buzz that's being generated now. And I am curious about brands like that kind of ebb and flow. Fashion is so fickle. You know, we love one thing this year, and the next year we're on to something else. I mean, what do you do when you've sort of lost that mojo? What do you do to get it back?
Well, it's a really good question with not an easy answer. I've lost it a couple of times over all the years. In one case, I was pushed out for getting what you did for the last 15 years. And you have to have the right person at the top. It's very simple. I'm listening, I'm studying founders, even at this stage in my life. Each and every one of them talks about, I preach this, and AI will not provide instinct, gut, seeing around corners, negotiating with factories. You must come with the vision, you must come with a point of view, and you must be very strong about maintaining that. There are a lot of brands out there, they make mistakes. Why? Because the board of directors is hiring maybe a safe but the wrong person. Our industry is why I love it. Every single day is a big challenge, you know.
But I'm fascinated about sort of the balance between having that gut instinct as a merchant or as a designer, as a creative, relative to the use of data, which is becoming a little bit more important. It's not just, of course, what we're seeing at Tapestry. We've seen this at Nike. The idea of, at least with the previous CEO, of a heavier reliance on data. And we saw that backfire, at least for that company. And I'm wondering, is there some sort of middle ground there between these two?
I hear data. It's the most popular word in the world right now. Give me data is historical. Give me data. When I was a buyer at Bloomingdale's at 24 years old, I did all the data I needed, but the data was looking forward, not the rear view mirror. And people start to establish a point of view based on what happened last year, 2 years ago, not on what will happen in the next 2 years. You look at a great brand and you're going to look at great leadership, not just the CEO. You're going to look at creativity, you're going to look at taking risks. And data, I mean, I really am allergic to the term. It's very popular now. I think our business, I mean, if you look at the creative world, ours is at the forefront, and I think it's lost in a lot of places. I think the world's become less creative in every category, and because of technology to a point.
Yeah.
You know, I don't know. I think technology is designing all the cars in America today because they all look alike. I don't know if it's the same design room, but creative, you take risks, you lose, you win hopefully more often, and I think that's missing. You know, I had a friend when I was commuting back and forth San Francisco. He ran a really good hotel. I never heard of this expression. This is 50 million years ago. The fish stinks from the head down. And if you look at companies, you look at not the fish, you look at the team. And if you don't have a great team, none of us do it alone, and you have to be inspirational. Now, there's a lot of short-term thinkers in this market. I've worked for a few of them. What are you going to do for me lately? Very much mercenary in a sense, quarterly stock prices. To me, when I take a new job, I don't think about when I'm going to leave because the stock price is up.
Right.
Long-term vision, it takes at least 5 to 10 years to create an impact and build a great company. It's not a turnaround in stock price in 2 years.
Well, Mickey, I hear what you're saying, especially when it comes to data, obviously very popular, maybe second only to AI, but do you think that there's any one company, any one industry that is using it right? Because at a certain level, you do need data. You do need
the data, I just never called that. When I was a buyer at Bloomingdale's, I was very good in math in high school. I hated science, but math. I say you can't run a company without the right data. But the data needs to be forward thinking and not rear view mirror. If you have a great product, you have to think out of the box. We have some things now that are beyond. And I say, just take a shot. Go for it, big time. And the downside is this. You got to measure your downsides. Data was always important. I always used to say to people, I still do, I said, you can't run a great business just as a merchant. You need to be really good at reading the data. I never used that word. I'll use it now.
Yeah.
And I do want to talk a little bit about marketing. I mean, you said that, at least what I heard was that it feels like people aren't taking enough risks. Let's talk about American Eagle. Let's talk about Sydney Sweeney, because I was reading some of your recent comments that you don't think that the company handled the response right.
Well, Jen Foyle's a good friend. I spoke to her. I said the wrong word. I don't know if it was somewhere on TV. I said they should have apologized. So I wasn't going to argue. I just said it's making a molehill out of whatever mountain. It was no big deal. And then they did well for the next 3 weeks. Sydney Sweeney, and she probably was a terrific choice. I would have said we made a mistake. People who say we made a mistake.
But was it a mistake? I mean, you think about what we heard on their earnings day. Apparently, they've brought in a lot of new customers on the heels of this.
You know something? Earnings days are days where people like to say good things about their companies. How did they know on the earnings day? I don't know. I'm a cynical, I'm a contrarian, and I don't think there's much credibility in most organizations in terms of, and I had to do the quarterly things. I hated it, but it is what it is. If I knew now what I knew then if I knew now. But I find if you look at the world today, you know, you look at the marketing, everything is on sale.
Yeah.
There are real prices out there. It used to be illegal, actually, when there were laws in this world, to inflate retails and then take the markdowns. I'm, again, cynical, suspicious, and I think what I think.
All right, Mickey, never enough time. Really great to have this conversation with you. That is Mickey Drexler. He is chairman of Alex Mill and former CEO and chairman of J.Crew.
And Gap.
And Gap.
Don't forget the Gap.
In Old Navy and Maybe.
We'll be back in a moment. This is Bloomberg. We want to take you back to that breaking story in the world of politics. Charlie Kirk, he is the executive director of the conservative Turning Point USA Advocacy Group, an organization that he started back when he was just about 18 years old. We're now learning, based on some communication on social media by the President of the United States, that Charlie Kirk has died. We did have reports earlier today that there was a gunshot fired at Charlie Kirk at an event in Utah earlier today. Charlie Kirk is 31 years old. There's a lot that we don't know and a lot we're still trying to find out. Joe Mathieu joins us right now. He is the co-host of Bloomberg's Balance of Power. And Joe, I know this is a very fluid situation. We've gotten some information from authorities and now what appears to be some information from the president himself.
Yeah, it's pretty remarkable to see this coming from Donald Trump. The great and even legendary Charlie Kirk, he writes, is dead. This is an individual who was part of a large collection. To your point, he started to make his name at a very young age. He was still very young when he died at 31 years old. And we should note he had a young family with a couple of young children. But one of many non-elected Republican conservatives who helped to form the MAGA movement and carry Donald Trump twice into the White House. Donald Trump is still surrounded by a number of unelected advisors and Republican conservative thinkers like Charlie Kirk. And this has to be sending a real chill through the movement and through the White House this evening. Romaine, this is not a partisan affair when it comes to political violence in this country. When you go back to the attempted assassination of Donald Trump, of course, the more recent assassinations that we saw with politicians in Minnesota and the governor of Pennsylvania. This is the latest in a string.
All right, Joe Mathieu is going to be sticking around from our studios in Washington, D.C. We do need to take a commercial break. That does it for Katie and us here on The Close. But you do want to stick around for Balance of Power. They are going to have some more details on a still developing story that the conservative activist Charlie Kirk is dead. This is Bloomberg.